Hey everyone, welcome back to Corporate Decoder, the place where we take a look at the nitty-gritty details of corporate filings. Today we're diving into Virtus Investment Partners' latest quarterly report, and let me tell you, trying to decode this thing was like trying to understand why your grandma forwards those chain emails. Get ready for some financial gymnastics. This report, officially called a 10Q, basically gives us a peek under the hood of Virtus's financial health for the first 3 months of 2025. We'll break down what's working, what's not, and what it all means for this investment company. It is a lot of work, but we do it for you to save you the effort. Before we get started, if you're into getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. First things first, this is a Form 10Q, which is a report that public companies must file with the Securities and Exchange Commission, or SEC. It's a quarterly report, meaning it's filed every 3 months, and it gives investors an update on the company's performance. This particular report covers the period ending in March of 2025, so it's pretty recent. It includes financial statements, management's analysis, and other important information. As of late April of 2025, Virch had almost 7 million shares of common stock outstanding. This is important to know because it affects how we calculate earnings per share, which we will see later. Now, let's jump into the good stuff, the financial statements. We'll start with the balance sheets where the company shows what it owns, also known as assets, and what it owes, which are its liabilities. Looking at the asset side, their cash and cash equivalents decreased significantly, dropping from about $266 million at the end of the prior year to about $135 million in March. That's quite a plunge and usually means they used a lot of cash to do something. Their accounts receivable, which is money owed to them, is at about $113 million. This shows how much revenue they expect to receive soon. On the liability side, we see notes payable of CIP, which stands for Consolidated Investment Products. This is a big number, over $2 billion. It looks like they owe a lot of money in that area, but it did decrease since the end of last year. Overall, their total liabilities are about $2.7 billion, which is also a very significant amount. It also represents a major decrease from their liabilities from the end of the prior year. Switching to the income statement. Here are a couple key numbers. Net income attributable to Virtus Investment Partners was $28.6 million. Earnings per share diluted was $4.05. Their total revenues were about $218 million. The biggest portion of their revenue came from investment management fees, but this has decreased compared to the prior year period. Total operating expenses were $181.3 million, which were also significant. They also have deferred tax assets of close to $22 million. Tax assets are good, those can lower their future payments. Let's look at the cash flow statement. This is really where the story is. Their net decrease in cash was a whopping $180.7 million for the last 3 months. Seeing that high of a decrease usually indicates a significant shift in their financials that might concern investors. They spent $20 million to repurchase their own shares. Buying back shares can artificially increase the stock price since it lowers the number of available shares. There's also a $123.6 million payment on CIP borrowings. This indicates that a lot of the cash was used to lower debt obligations on their consolidated investment products. This could signal a move towards deleveraging those products. The foreign currency translation adjustments generated a bit more than $292,000. Their total equity ended up being about $896 million. Now, let's dig into where their revenues come from. Most of their revenue is generated through investment management fees, which totaled $186 million. The bulk of the money comes from providing services they earn from managing other people's money. Let's dive into operating expenses. A sizable chunk, $33 million, is attributed to other operating expenses. It's like when someone asks what their money went to and they just say stuff and might need deeper scrutiny. Amortization expense, reflecting the cost of intangible assets over time, was nearly $113 mailers. They hold investments in their own sponsored products. This is common to align with their investors. It basically means they are eating their own cooking. Most of the investments and cash are level 1 assets, which means they are easy to value. This gives more stability and transparency. Most of the intangible assets are definite-lived. This means they are amortized or written off over time. Not having indefinite-lived assets decreases the risk. They make significant payments of contingent considerations. This could mean there are ongoing acquisitions or the business is very specific. They declared a quarterly cash dividend of just under 2.25 per share. This is a way to provide value to shareholders. They repurchase quite a bit of shares on the open market. They manage their own non-qualified retirement plan assets. Let's look at the cash flow statement. The decrease in cash was really driven by changes in operating assets and liabilities, mostly due to accrued compensation and benefits. Also, they continue purchasing assets of their own consolidated investment products. Overall, nothing sticks out too negatively, and their legal proceedings seem to be standard. There isn't anything here that should scare investors. A significant portion is attributed to redeemable non-controlling interests, implying that they have external stakeholders and have financial impacts on the company's equity. Also of note is that they use collateralized loan obligations, see CALOs. These are not inherently bad. They can be used to generate income, however they are complicated and might be a signal to dive deeper. Their effective income tax rate is also quite a bit higher than the prior year. This can be a big indicator of where they have operations and the political tax environment and their ability to tax plan. The key measure for their profit and losses is net income. Remember, everything we've discussed is based on their own reporting, which comes with its own set of assumptions and risks. So what's our take on Virtus? They're a pretty standard investment company, but there are a few red flags. They have a consistent but significant decline in assets. Their revenues also declined and rely a lot on investment income. This paints a picture of a company that is currently struggling to generate more value for their customers and are paying debt obligations. If they don't get ahead of that, they might face pressure for profitability. Alright, that's our breakdown of Virtus's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.